Hey, good evening, everyone. Okay, I think in interest of time, I think we'll get started. So thanks everyone for taking some time on an evening and joining us. So today we wanted to spend some time with you and discuss some of the securitized debt investments opportunities that we bring on the platform, and see securitization as a concept of how we look at the receivables that are underneath those assets, and how do we use it as a form of bringing investment opportunities for investors to participate on it. There are some varieties and nuances that comes along with it, and that's what we wanted to spend some time today to talk about that. So we do bring a lot of investment opportunities from a structured debt investment opportunities right on the platform. And I'm with me, Prateek is there. So myself, Jayaprakash, I manage the growth at AllGraph. And with me, I have Prateek. So Prateek, you can introduce yourself.
Thanks, JP. Good evening, everyone, and welcome to our webinar. JP stated our objective of the webinar is to just introduce securitization to you. As a quick background, I'm a civil engineer by trade, then an MBA from IIM Ahmedabad. Then I was a banker with the Royal Bank of Scotland, looking after the bank's balance sheet from a risk return perspective with their capital allocation and portfolio management team. Then a stint in private equity, when I was investing in financial services and logistics, then venture capital for 5 to 6 years. And then I've been with AltGraph, and I head strategy for AltGraph, been with the company for just about 3 years now.
Prateek, I think from for everybody. So what we'll do as a timing standpoint, Prateek, if I may, what we'll do is we'll spend some time, a little bit, breaking down and simplifying what securitization is actually means and how it actually comes into picture when a customer thinks about from an investment standpoint. So we'll cover the basics, and then we'll spend a little bit of time on a couple of opportunities that we have on the platform, which are in the form of this structured debt investments, and then we'll spend a lot of time on the questions. And I'm sorry, Pratik, I think you can go ahead. So that's for everybody in terms of what we'll do, and we'll try to take as many questions as possible at the end.
And for anyone who has questions, please feel free to type them in the Q&A box. We will then try and cover them through the presentation, as well as definitely towards the end, we'll try and take up all the questions that have been posed. Now, what is securitization, right? It sounds a very financial jargon, but ultimately, in simple terms, securitization means that if someone has taken a loan, the provider of that loan can assign that to someone else. And I'll explain that through an example. Let's say your Shriram Finance has given 10 people 10 different loans. And Shriram Finance then decides that, look, I want to give more loans. For that, I have to get cash upfront. So they will take these 10 loans and, in financial jargon, securitize them by giving these loans or creating a pool of these loans and assigning it to a special purpose entity. That process of someone, an originator, the one who originates the loan is called the originator, the original underwriter of the loan. The process of assignment and the subsequent act of it is called securitization, where effectively you are taking a pool of assets, could be loans, could be trade receivables, could be all forms of loan. It could be gold loans, it could be consumer loans, it could be vehicle loans, it could be corporate loans. You can take any form of underlying cash flow generating asset and put them in a special purpose entity, and that process would be called securitization. Why people do it? To deleverage their own balance sheets, to create capacity to do more. So, for example, taking the Shriram Finance example ahead, the moment they have securitized the 10 loans, they would have got cash upfront, which they can redeploy and give out 10 more loans. So tomorrow they will have 20 loans outstanding, 10 on the books of the special purpose entity, 10 again on the books of Shriram Finance. Now, how it helps them is, if they are keeping, let's say, what is called an additional spread that adds to their income. So that is how financial institutions try and deleverage their balance sheets by doing a process called securitization. Now, I've mentioned they would get capital upfront. How do they get capital upfront? That comes from that special purpose entity raising money through the issuance of an instrument, which could be called a securitized debt instrument or a pass-through certificate. In simple terms, what does that mean? It means that whatever cash flow is realized from the underlying pool of assets, we are taking the example of simple loans that has been given by Shriram Finance, all the cash flow, all the repayments that will come of those particular loans will be passed on to the holders of such SDIs or pass-through certificates. How does that benefit the holder of SDI or pass-through certificate? You have now got a fixed income asset which will work like a bond, which will give you identified cash flow in a defined repayment schedule over the life of that instrument. So for example, if Shriram Finance had given a consumer loan of, let's say, 2 years, where a monthly EMI will come, and they securitize that pool in 2 months of that tenor. So there is balance 22 months remaining. For the 22 months, the EMI will come to whoever is holding the SDI or the PTC of such a securitized pool. This is actually a fairly common instrument used in the financial institution world, where banks and NBFCs use this to deleverage their balance sheet and grow credit in a particular geography, to expand their own presence, and use this quite frequently so that they don't have to raise equity capital again and again, and their debt to equity remains under control. Why the investors like it? Because typically they will say that when you are assigning a pool of loans, it has to be of high quality. There has to be some skin in the game from the originator. It has to have some track record, and it becomes diversified because then your risk is not hinged on one particular entity. If in our example, 10 loans were assigned by Shriram Finance, if one of them goes bad, the holder of the SDI and PTC should not lose money. So when you, let's say, these 10 loans have assigned, you might only give out capital for 9 loans of it. One is used as over collateralization. We will explain all of these terms as we go ahead in our presentation as well. But maybe to simply summarize, securitization is a process where an original underwriter takes the pool of assets, which could be loan, which could be trade receivables, and puts them in a special purpose entity to raise capital. In India, this is regulated by both RBI and SEBI. RBI regulates it when the originator is a financial institution, could be a bank, could be an NBFC. SEBI regulates it when the originator is not a financial institution. So it could be a corporate which is perhaps doing trade receivables and then wants to securitize the same. A little bit of history of, and sometimes we do not appreciate how old actually securitization is in India. The first securitization transaction was held in early 90s, which was done by Citibank. And this was even more popular in the West. And they sort of said that, look, we have found a way to deleverage balance sheets. And if we do a securitization, then people can get identified cash flows. We will actually be able to create high quality assets and solve the problem of growth for Indian financial institutions as well. Since that time, the market has grown. Regulators have come out with very, very clear guidelines. Both RBI and SEBI have laid down securitization guidelines. Between 2013 to 23, the market has grown almost 2.5 times. Today, that market is more than 1.9 lakh crores. So on this slide, you see the securitization market as it exists in India today is nearly a $15 billion market. And these are loans that are already being securitized. These are loans that are already being part of this ecosystem. The difference is, from our perspective, the difference is this market is largely almost 99% of it in the institutional space, where the originator, the entity which is securitizing such loans or such receivables, is also a financial institution, as well as the subscribers to such securitized products are either financial institutions or mutual funds or pension funds which are looking to get yield-bearing assets for the longer term. So if Shriram Finance has given a loan for 2 years, a pension fund might buy a securitized asset and say that, look, for 22 months, I have got a good product which will keep giving me a fixed rate of return over that period of time. What this slide also tells us is that in the developed world, the markets are even larger, more than 50, 60 times of what it exists in India today. So there is plenty of potential for growth. We've just used US as a benchmark, which is almost $500 billion of a market. There it is even more frequent of how people securitize their assets and then raise capital. The key benefit in all of this is trying to create a win-win scenario where the original underwriter, using the skill of them being able to originate high quality assets, being able to underwrite high quality assets, can continue to grow, whereas people who can then choose the high quality assets to create a fixed income product for themselves. And all the layers in the middle are then contributing to propel this ecosystem. We'll spend a fair amount of time trying to understand this particular diagram, which in a way summarizes how a particular securitization works. I had mentioned this is the original originator, and I'll come to the servicer separately. Let's say there is Shriram Finance, whose first job is to identify high quality borrowers and give them loans. I'm not going into trade receivables right now. We'll cover that at the end of the session. But from a simplicity perspective, there is a Shriram Finance who is then giving loans to counterparties, which in their case might be individuals. Once these loans are given, and in RBI guidelines, there are norms such as you have to wait for 2 months so that 2 repayments are done. Only then you can securitize it. You have to then hold a little bit on your own book so that there is skin in the game. So all those guardrails are also present. But once an originator has given these loans, has fulfilled the guidelines as laid down in the law, then you can assign the loan receivables or the loan pool to an SPV. These are typically trusts, which is managed by a SEBI registered trustee. So all the underlying cash flows, all the underlying rights, legal remedies, obligations of the same move to the trust. So this pool is then assigned to a trust. Now, the first level of nuance is any investor who's looking at this particular pool, this becomes the actual collateral, the actual strength on which you are participating in such an asset. So the quality of the loan pool is one of the key guiding principles of how good a securitized product is. If these loans are given to well-earning, let's say CIBIL score above 750, it's very, very granular, then it's a very high quality pool. If it's then given to, let's say, people who are CIBIL score 600 or 500, then maybe it's not a very high quality pool. So the quality of the pool plays a very key role in determining what is the quality of the, or what is the credit risk underlying such a securitized instrument. To complete the process, then the SPV issues pass-through certificates where individuals subscribe and pay in capital to the trust. Trust then passes on that as consideration to the originator. Whenever the repayments come, they can be directly provided to the trust, or they can also flow through the originator or the servicer, who can be given the job, the specific job of collecting money. So one of the key criteria in this is who collects the money from the borrower. Now, the deepest link that you will have is from the original underwriter who actually gave the first check or the first money to the borrower. They will have the deepest relationship with the borrower. So if somebody has to actually go and say, please pay back the amount that was due to you on that particular day, Shriram Finance will go to the borrower. Shriram Finance would know the customer best. They would go to the borrower and say that, look, you have to pay on this due date, so please pay. In that case, the trust can appoint a Shriram Finance as the servicer. Now, what happens if Shriram Finance doesn't want to do it, or for whatever reason, the trust thinks that, look, this is not being done right? The trust will have the right to appoint anybody they see fit as a servicing agent. The servicing agent also plays a very key role because ultimately they are the conduit for the SPV to talk to the original borrowers. I will now mention maybe a concept called credit enhancement, where one of the reasons why financial institutions or originator, apart from deleveraging their balance sheet, use securitization is actually to lower their borrowing cost. And how do they do that is they will say that, look, I am giving loans to people who are CIBIL 750, people who are CIBIL 700, and people who are 650. But I will assign you high quality loans, people who are CIBIL 750 plus. Along with that, I will also keep 5% as cash collateral. Along with that, I might also give a financial guarantee. Along with that, I might say that, look, if I am assigning loans worth 10 rupees, you only give me 9 rupees against that, which forms over collateralization. By doing all of these three things, they will say that, look, if my cost of borrowing, or if I issue a bond today, my cost of borrowing is 10% for this pool, which is better because you're giving me 10% for the balance sheet underwriting that I'm doing. Now I'm providing you a cash collateral. I'm also giving you over collateralization. Can I get the money at 9%? So that difference of 1% or that difference in borrowing cost is created by providing credit enhancements, by increasing the quality of the loan pool, and by providing further safeguards as the originator can try and do so that their cost of borrowing comes down. There is another concept called excess interest spread, which is if I have lent out money at 16% and my cost of borrowing is 12%, and ultimately the SDI is being issued at 11%, the difference between 16 to 11 is called excess interest spread, which is 5%. This can also be used as a manner of credit enhancement, where in case there is any stress in the SDI, all of these can be exercised so that the investors do not lose any money. The biggest benefit, of course, of the SDI is that you are sitting on a very diversified pool. You are not taking any single entity risk. So by holding an SDI, perforce you have created a fixed income portfolio. Now you can obviously describe it or and spread it even further. At the moment, let's say it's all CIBIL 750s plus loans that are underlying, but are the loans everything from Karnataka, are the loans everything from Maharashtra? Can any event in those particular states impact the repayment ability of the borrower? So you can say that no, in this pool, half the customers have to be from Karnataka, half from Maharashtra. So then it becomes diversified between two states. You can introduce third, fourth. You can become very, very granular. As you go more detailed about the pool cut, you can actually go and become very granular and increase the quality of the pool. In summary, I would say the key in this is the quality of the origination. So originator and their underwriting ability is one key factor for credit risk. Quality of the pool needs to be checked from an investor standpoint, saying how good is the pool? What is the granularity of the pool? Am I participating in bad assets or good assets? What is the track record of the underwriter? These form key factors for judging whether when you're participating in a securitized instrument, whether that is high quality or no. And then third level is, of course, what is the cash flow control that you've got? What are the credit enhancements that are present? Then you can judge whether from a risk return standpoint, it adds up to it or not.
Thanks for joining. And Prateek, anything you want to say?
No, thanks for joining. Same message. If you have any questions, please do reach out to us and to our team. We'll be very happy to answer these questions and explain securitization. If you want us to cover some more aspects of securitization, do write into us and we'll try and cover it in a second webinar, and we can go into as much nuance as you would like.
Perfect. Thank you very much. Thanks for taking the time once again. Have a lovely evening.
Thank you. Good evening, everyone.